Hi, this is Vijay Bambani. I wish you a very happy and a joyous Christmas and a happy new year in advance. I hope you're happy with the levels that we've been giving you for over 2.5 months now about the markets, and you've benchmarked our performance vis-a-vis the market levels being achieved out there. Now in this video, in this week, I'm going to talk to you about what to expect in the markets next week. Do remember that the coming week is likely to be a lackluster one where volumes are concerned. We have 31st and the 1st. Both days are historically low volume days with trader participation being truncated. So be careful about this aspect of the market. Like 2 weeks ago, since the last 2 weeks, I've been warning you as Christmas approaches and New Year approaches, impact costs can rise, the bid and offer spreads can widen, turnover can fall. So to that extent, you need to be extra cautious. As far as the market is concerned, last week we saw finally a semblance of a correction stepped in. Basically, the tone and tenor was set by the big decline on Monday itself, the first trading day of last week. And the highs reached on Monday have not been tested in the following 3 trading sessions, even though the markets attempted to crawl higher, but many counters failed to reach the highs of Monday. Going forward, as we proceed in this video, I'll explain to you why those peaks are important. But that said, look at the market roundup graphic on your screen. As you can see, the Bank Nifty underperformed the Nifty 50, which was expected. I've been saying that the Bank Nifty looks relatively weaker as compared to the Nifty. Therefore, traders are better off focusing on the Nifty itself. The primary reason was the bond yields and the US dollar index. Now, unfortunately, a whole lot of market traders out there ignore the correlation between banking stocks and Bank Nifty on one hand and the 10-year benchmark bond yields on the other. And similarly, the US dollar index vis-a-vis the broader markets itself. Now, we like to have a 360-degree worldview of the financial markets and therefore like to take as many variables into our computations as far as possible. So we keep you updated on this aspect. As you would see on your screen, bullion and energy also fell because of a steady dollar, and the 10-year benchmark bond yield held its ground at 5.96%. That was unchanged. The MWPL, the market-wide position limits, fell ahead of expiry, as you can see on your screen on the MWPL chart here. Coming up on your screen now is the chart of the basis, the difference between the futures and the spot market. And the basis screen shows expansion on both indices, both the Nifty and the Bank Nifty, because bear covering was seen in the latter 3 days of the week. Basically, bears went aggressive on Monday, expecting the declines to deepen, but they were caught on the wrong foot, and on Tuesday, Wednesday and Thursday, they were forced to reverse their short positions, which is why the basis went up. The premium in the futures went up. The index and the stock volumes chart, as you can see on your screen, shows a huge spike on Monday. That was the falling day. But those levels of turnover were not seen ever since on Monday. Although on Friday itself, the market does seem to have the volumes perk up a bit, but it was nothing compared to the big surge on Monday itself. Now, this is an aspect which is crucial to watch because the coming week is a holiday impacted week, and therefore, like I mentioned, impact cost, bid and offer spreads will need watching. Coming up now on your screen is the 10-year benchmark bond yield. The sovereign yield remained steady at 5.96%, and the RBI did not buy any offerings, which is not really very surprising to me because I've been saying that as the fiscal deficit spills over and exceeds the budgetary limits, the probability of fresh bond issues by the RBI is fairly high. The government will want to mop up more money, and they'll basically need to provide more and more stimulus to a pandemic hit economy. Now, this will have a direct bearing on the banking stocks as well as the bank Nifty. And we'll keep you updated about this aspect. As a matter of fact, I keep updating this aspect on my social media pages every day, Monday to Friday, post-market. It would help you if you stay in touch with me via social media. The contact coordinates come at the fag end of this video. The 10-year benchmark bond yield now done. We go to the Dixie, the US dollar index. It fell on 3 out of 4 trading sessions with Christmas, the 25th December being a holiday. But in spite of that, it wound up gaining 0.3% on a week-on-week basis. Now, this index can, as you can see on your screen, is under pressure, but any rally in this index can actually pressurize emerging markets, including India, and therefore this index needs watching. It still remains below its 25-day exponential moving average, as you can see on your screen, which is placed at 90.95 levels. And this index must break out above the 25-period exponential moving average to signal any kind of strength. Last week, I advocated a range between 91.25 on the upside and 88.75 on the downside, which held. Next week, I expect an estimated range. Now, I emphasize on the word estimated range of 91.50 on the upside and 89.05 on the downside. Watch this space for guidance on commodities, especially bullion and energy, as well as the overall equity markets. I now come to the bank Nifty, the second most liquid counter out there in the NSE F&O space. Now, this index underperformed the Nifty 50, which I have been advocating for the past 2 weeks. And the primary reason was bond yields and the strength in the dollar. The big fall on Monday tested the reserves of the bulls and the 25-period exponential moving average, as you can see on the chart on your screen. The remaining 3 sessions saw recovery, but unless the top of Monday, which is a red candle, a gigantic red candle, is overcome sustainably, don't expect any major upthrust to sustain. I expect this index to continue to remain more volatile, relatively speaking, as compared to the Nifty, and also probably even underperform the Nifty 50. In the week before last, this index was number 5 on the most volatile counters list. Unfortunately, in the week gone by, it climbed up to number 3 due to the sharp moves that we saw thanks to Monday's major decline. Now, I expected a range of 32,125 on the upside and 29,300 on the downside last week, which was violated by 100 points or so on the downside on Monday. The coming week, I expect to see an estimated, I emphasize on the word estimated here, range between 31,850 on the upside and 28,950 on the downside. Staying above the 25-period exponential moving average should provide comfort to people holding long positions. And do remember that the coming week is likely to be a low turnover week. Therefore, your impact costs, your bid and offer spreads, and order fills might get impacted. You're still better off trading the Nifty 50, relatively speaking, of course, as compared to the bank Nifty. So continue to trade light on this index. I now come to the most liquid counter out there on the NSE, the Nifty 50. It fell on 1 out of 4 trading sessions, but the fall on Monday was big enough to kind of rattle the bones of the bulls, and it also resulted, in spite of the rallies on the following days, to keep the Nifty in the red, although the Nifty wound up losing only 0.08% on a week-on-week basis. Now, along expected lines, this index outperformed the bank Nifty and remained above the 25-period exponential moving average. The big red candle of Monday needs to be overcome. That will be a clear signal that the bulls have shrugged off their worries and the nervousness which they saw on Monday. which is why I've been saying that Monday's major decline, whether it is individual stocks, individual stock futures, or the indices, the highs of Monday need to be overcome in order for the bulls to send out a clear and undeniable message to the bears. Watch out, we are coming back and we are still in control. So once Monday's high is overcome on a sustained closing basis, a new rally has a probability of unfolding. Now look at the weekly chart on your screen of the Nifty 50. It indicates a dragonfly doji. The open and close are almost the same for the week, which is why the Nifty lost 0.08% only. Whereas there's a big shadow on the downside, which means there was a big tussle between the bulls and bears, but ultimately the bulls managed to keep the closing somewhat close to the opening and in the upper range of the intra-week parameters. So on the daily chart coming up on your screen, you can see that as long as the bulls keep the index above the 13,778 mark in the spot segment. Now this level, this power candle, the red one on Monday, has been marked by two arrows. Once you take the top out and overcome it on a sustained closing basis, the upthrust has a possibility of continuing. Therefore, you need to watch this 13,778 level very carefully in the coming week. In the week before last, the index was number 9 on the most volatile list. It remained on number 9 itself, which means where volatility is concerned, it was less volatile than the Bank Nifty, which is why I say that you are better off trading the Nifty as compared to the Bank Nifty on a relative comparative basis, of course. So last week I advocated a range of 14,175 on the upside and 13,350 on the downside, which was violated on Monday by a very small degree. And the coming week is likely to see an estimated, I repeat the word estimated, range between 14,175 on the upside and 13,325 on the downside. Now here again, I advocate that you trade with light exposure because this is a holiday impacted week and turnover is likely to be light. However, the impact cost will not rise as much as the Bank Nifty and select individual stock futures. So trading light seems to be a good option here. Now the indices done, I come to the most popular segment of this video, which I receive feedback from my viewers, is the top 5 counters which are suitable for high impetus, high volatility traders and low impetus, low volatility traders. Now, high impetus, high volatility stocks are those where you take a small exposure but you expect bigger price moves. And low impetus, low volatility stocks are where you take a large amount of exposure but wait on very small price moves before you can flip your trade over. So coming up on your screen is the list. The high impetus, high beta stocks where you will take small exposure but wait for large price moves is led by Mindtree at number 1, number 2 IndusInd Bank, number 3 McDowell, number 4 SBI, number 5 Manappuram. The low beta, low impetus stocks where you will take big exposure and wait for small price moves is led by Kotak Bank at number 1, number 2 Nestle, number 3 Naukri, number 4 UPL, number 5 Larsen and Toubro. So friends, before I wind up this video, coming on your screen are my contact coordinates. I would love it if you connect with me on social media. We can have conversations going. I put up a lot of statistical matter and content out there post-market late in the evening, which I think will help you become better traders with our in-house statistical model, which we call the Barracuda. It throws out a lot of research, which I share with my viewers on social media. Do take the time out to connect with me if you feel so. Wish you a very happy festive season, my friends. I bid goodbye to you, promising you to come and see you again in my next week's video. Have a very, very profitable week ahead. Feel free to refer this video, subscribe to my YouTube channel. Share this video with your family and friends and click on the bell icon to receive alerts about fresh videos coming up on this YouTube channel. Thank you for watching me. Take care. Bye-bye.